Welcome to The Explainer. If you're trying to figure out how to build a killer stock portfolio for 2026, you are in exactly the right place. We've taken all the expert financial analysis and boiled it down into a clear, actionable guide that's going to help you invest with some real confidence.
So this is it, right? This is the big question on every investor's mind. So what are the pros actually saying about it? Well, we've broken down their core strategies to give you a super clear roadmap for tackling the market.
All right, first things first, where should you even start looking? You know, a winning strategy always begins with finding the sectors that are really set up for some major growth. Let's dive in and see what the experts are pointing to.
Okay, so one of the biggest signals out there right now is a massive boom in tourism. But you got to think beyond just the hotels. This whole thing creates this powerful ripple effect. Think about it. A tourist checks into a hotel, right? Then they go out for dinner, maybe grab a drink. That one simple action boosts demand for local food, for poultry producers, and yeah, even for breweries. It's like an entire ecosystem getting a lift from every single new visitor.
Now, beyond that, we've got two other massive engines just firing up: exports and energy. So on one hand, you've got government promotion fueling a ton of growth for export-linked businesses. We're talking shipping and logistics. And on the other hand, energy demand is just skyrocketing by over 10% every year. That makes the renewable energy sector not just important, but absolutely critical.
And here's where it all kind of comes together. When the economy is healthy, when it's growing, who's making all that activity happen? The banks. They're literally the backbone of all this growth, which is exactly why analysts see them as a key ingredient for any stable, well-rounded portfolio.
Okay, so now we know where to look. But here comes the really crucial part: how to look. I mean, spotting a hot sector is one thing, but the real skill, that's picking the winning companies inside that sector.
This slide really gets to the heart of the difference between how amateurs and pros think. It's so easy to get fixated on those surface-level clues, things like the stock price or the PE ratio, which is basically just a quick look at how the market values a company's earnings. But the real story, the good stuff, is way deeper. The pros dive in and analyze the balance sheet. They check to see if the company's actually generating cold, hard cash, and then they project where its future earnings are headed.
And this, right here, is probably the single most important piece of advice from the experts. It is not about blindly following one number. It's about empowering yourself to truly understand the why behind your investment. That's how you make decisions with real, genuine confidence.
So, to make it practical, here's a simple 4-step checklist to guide your research. You start with the basics, right? P and price-to-book ratios. Then you immediately dig into the balance sheet to check its financial stability. Now, step 3 is a big one. Does it have positive operating cash flow? In other words, is its main business actually making money? And finally, you look to the future and try to project its earnings potential. Of course, look, all investing has risks. We know that. But there is one risk that is 100% avoidable, and that's getting scammed. And here's the crucial point. You absolutely have to know the red flags before you invest a single dollar. Your awareness is your single best defense.
These are the classic warning signs. You need to be extremely wary of anyone promising guaranteed high returns or putting a ton of pressure on you to act now. A really common tactic scammers use is to lie about where your money's going. For instance, they might tell you your cash will be deposited into a CDS account. That is a huge red flag. A CDS account is for holding your shares, not your cash. If you hear anything that sounds like this, it's time to just stop and verify everything. The solution, believe it or not, is actually very straightforward. No matter where you are, investment advisors are regulated. In a lot of countries like Sri Lanka, for example, they have to be registered with a body like the Securities and Exchange Commission, or SEC. Before you work with anyone, you can and you absolutely should go to that official regulatory website and verify their credentials. It's a really simple step that can save you from a massive headache later on. Okay, so it's time to put all of this together. We've covered where to look, we've talked about how to value companies, and we know what to avoid. Now, let's turn all of that expert advice into a simple blueprint for your 2026 portfolio.
So here are your 5 key takeaways to guide you. First, focus on those high-growth sectors we talked about. Second, always dig deeper than just the surface-level numbers. Third, make positive cash flow a non-negotiable. Fourth, do your own homework to justify every single investment you make. And finally, and this is a big one, always verify that you're working with a legitimate, registered professional.
So there you have it. We've given you the map and we've given you the compass. You are officially at the starting line, and you're equipped with expert knowledge. The only question left is, what's the first step you're going to take to build your 2026 portfolio?